Are emerging market stocks and bonds cheap enough? They've certainly been pounded, and if you look at historical evidence, they are not expensive. They are trading at lower PEs, lower book values than the U.S. market certainly, and in their own historical terms, they're reasonably priced. So the question of whether they're cheap enough really depends on what you think is going to happen, which means that you're dependent on news flow. And here's how I look at this, that if you're thinking that the September and October is going to bring big turmoil in the U.S. markets because of fights over the budget, worries over the Federal Reserve taper, another battle over the U.S. debt ceiling. If all those things happen and put fear in the market, even though the fear starts in the United States, it tends to have more of an effect on emerging markets. As I've said a couple times recently, if people get afraid, they put money into treasuries. Nobody ever looks to put money into Peru for a safe haven. So if you get turmoil in the United States, I think emerging markets are going to go down further. The other question, of course, is whether we're looking at an emerging market crisis in any country. Not so much an economic crisis. That's the worry that Chinese growth is going to slow. I think Chinese growth might slow a little more, but not enough to produce a crisis. What we're really talking about is more like currency crisis in countries such as Indonesia or India or Turkey, countries that have a big need for flows of overseas money to balance their current trade deficits, and don't look like they'll get those flows unless they raise interest rates, which would then lower growth in those countries. So if you get further deterioration in the rupee or the rupee or the real or the Turkish lira, then I think you're going to see emerging markets take another step downward. So while you can say that right now emerging markets are inexpensive on a historical basis and in comparison to U.S., they might not be cheap enough if you're thinking that we might get a currency crisis, some kind of emerging markets crisis that would take them down to not necessarily where they were in 2007, 2008, at the time of the Lehman Brothers crisis, but cheaper than they are now. So maybe what you want to do is, if you want to look at this and say, okay, I'm not sure how far down these can go, you might want to look at buying some emerging market equities that have dividends to them, and they're coming from places where you're not likely to see a big effective currency crisis. So Singapore, where stocks tend to trade with a dividend of like 4%, 5%, just because Singapore investors like dividends. There's no foreign withholding tax there, so you get the full effect of that. So you might want to look at something like Keppel, which in the U.S. trades as KEPLY, or maybe Keppel REIT, which is K-REIT, but only trades in Singapore, or StarHub, again, only trades in Singapore. Things like that might give you some kind of dividend while you're waiting for a turnaround in emerging markets, but it would also give you some kind of protection in case these markets sell off a little further. I wouldn't go whole hog here. I think there's a good chance that you'll be looking at stuff that's going to get cheaper. One of the things that's interesting is that a lot of emerging market consumer export stocks have held up fairly well in this. So in Mexico, a stock like Gruma, Grumab, .mm, because it only trades in Mexico City, which exports tortillas and corn flour, held up very, very well. So the stuff that you're seeing go down in the emerging markets tends to be the commodity plays, the export industrial plays, the infrastructure plays, and those, I would argue, are probably not cheap enough. I wouldn't necessarily be looking to put any dollars into those sectors quite yet. This is Jim Jubak for Jubak Asset Management.